Hello students, welcome. In today's video, we are going to discuss about monetary policy, right? So monetary policy is nothing, it's simply the credit control functions of the central bank. Now, India's central bank is Reserve Bank of India. We all know that. So in situation, where money supply needs to be regulated. Now, what is the meaning of money supply needs to be regulated? In simple words, too much money in the economy, that means too much availability or readily available. If money is easily available, that may cause inflation in the economy. And if there is scarcity or shortage of money in the economy, that may cause recession in the economy, right? जब भी इकोनॉमी में पैसे बहुत ज्यादा हैं तो लोग उस पैसों को यूज करेगा और इकोनॉमी में इन्फ्लेशन हो सकती है, महंगाई होगी, राइट? एंड अगर पैसों की कमी है तो लोगों के पास अगर पैसा ही नहीं है या ज्यादा पैसा नहीं है या पैसा इजीली अवेलेबल नहीं है तो अल्टीमेटली क्या होगा? दे विल नॉट एबल टू डिमांड, वो अपनी गुड्स एंड सर्विस की डिमांड नहीं कर पाएंगे, इकोनॉमी बहुत स्लो हो जाएगी, राइट? एंड दैट इज that is a main cause of recession. So in this topic today we are going to discuss that how RBI, when we are talking about the central bank of any country, right? Like rather we take one example, that is India's central bank, and that is RBI. So how RBI is going to regulate, rather than we will be using the word increase or decrease, that is obviously these are the two aspects of the same thing. तो हाउ आरबीआई इज गोइंग टू रेगुलेट द मनी सप्लाई, उसको कंट्रोल कैसे करेगी? ज्यादा है तो उसको अब नॉर्मलाइज कैसे करना है, अगर कम है तो कहां से और इंजेक्ट करेगी इस पैसे को, ठीक है ना? तो वी हैव टू अंडरस्टैंड दैट वे कि टू मच मनी तो एब्जॉर्ब कर लेना है, लेस मनी तो उसमें इंजेक्ट करना है. नाउ इन सिंपल लैंग्वेज इट इज नोन एज मॉनेटरी पॉलिसी. तो हम एक सिचुएशन लेते हैं, बिकॉज एक साथ दो सिचुएशन को समझने से बेटर है कि हमने एक सिचुएशन ली कि इकोनॉमी में बहुत ज्यादा पैसा है. अगर बहुत पैसा है तो इसका मतलब लोग उन पैसों को यूज करके डिमांड कर रहे हैं, बट इट इज वेरी मच पॉसिबल दैट टू मच मनी chasing the limited goods and services. Now this is something you need to keep in your mind. Too much money chasing lesser quantity of goods and services in the economy. In simple language में you can say aggregate demand aggregate supply से ज्यादा है, aggregate demand aggregate supply से ज्यादा है. तो obviously there will be competition among the buyers, जिसके पास ज्यादा पैसा है या पैसा खर्च करने के लिए रेडी है, obviously उसको गुड एंड सर्विसेज मिलेगी. दैट मीन्स द वन हु इज रेडी टू spend money, he will able to purchase those goods and services. As simple as that, right? तो सिचुएशन है इन्फ्लेशन. अब उस इन्फ्लेशन को कंट्रोल करने के लिए या कॉम्बैट करने के लिए या उस महंगाई को कम करने के लिए आरबीआई क्या क्या स्टेप्स लेती है, उसमें से एक मॉनेटरी पॉलिसी सबसे इंपॉर्टेंट है. हम इसको फर्दर क्लासिफाई करते हैं इन द फॉर्म ऑफ tools and measures, right? So you can see tools to regulate money supply. Broadly speaking, it is classified, these tools are classified as quantitative methods and qualitative methods. Now quantitative methods are general methods. These are also known as general methods. Now when these methods are used, it is to impact and have an impact, I should say, on almost all the sectors, different sectors, yeah, people coming from different profession, different occupation, different businesses, you can say, from whichever the region may be, country का किसी भी कोने से है, उससे कोई फर्क नहीं पड़ना है. These methods are for all, मतलब these will have impact on everyone, right? Whereas when we talk about qualitative methods, these are selective methods, right? That means these methods are meant to target some specific issue it can be specific, a particular good, you may say a particular region, a particular profession, particular business को affect करना है, तो ये methods use करती है RBI to bring the required changes, right? So under quantitative methods, we can see we have repo rate, bank rate, reverse repo rate. We have reverse repo rate, cash reserve ratio, statutory liquidity ratio, open market operations. So we have got these prominent 6 methods or tools that we study under quantitative methods. Similarly, we have few tools under methods under quantitative method. These are the measures, that is change in margin requirement, regulation of consumers credit, credit rationing, moral suasion, publications and direct actions, right? So are you ready to understand each and every point, or you can say measure in details? Are you ready? Okay, so let's move on. So one by one, now as I mentioned earlier in this video, let us take the situation of inflation prevailing in our country. Quantitative method, which are also general methods. Under this, we are discussing repo rate and bank rate, you can say together. The reason being, though they are technically different, right? Their methods are also different, but impact and in simple language, theoretically, we can say both refers to the rate of interest. Remember, both refers to the rate of interest at which commercial banks borrow from the central bank. Now the question is, when we say it's a rate of interest, these represents rate of interest, still how they are different from each other. Though there are many differences, but when we talk about repo rate and bank rate is the rate of interest on that amount which is required for the immediate financial crisis, you can say, or for immediate need. Whereas repo rate, technically it is for a short term. Okay, when we say short term, short is comparatively longer than obviously immediate requirement. So when we talk about bank rate, in bank rate it is for immediate requirement that the commercial banks borrow from the central bank, and repo rate is from, as we mentioned, is a short period of time. In this, repo stands for repurchase option. So you have to understand that repurchase option, this REPO is repurchase option. Now in this security, matlab government approved security needs to be mortgaged, against which the commercial banks can borrow. In bank rate, no such securities are required to be mortgaged. So there are some technical differences. Otherwise, in short, we can say both are the rates, okay, at which a rate of interest at which commercial banks borrow from the central bank. Now it's, you are going to answer, think and answer, like suppose there is a situation of inflation. Now should these repo rates and bank rate be increased or decreased? Should these be increased or decreased to affect money supply, in the sense that money supply needs to be decreased? We know to decrease inflation, money supply needs to be decreased. So bank rate, repo rate should be decreased or increased. I'm giving you 5 seconds to think. Okay. So if your answer is that bank rate should be increased, bank rate, repo rate should be increased and bank rate should be increased, then you are right. By increasing bank rate and repo rate, what is happening? By increasing bank rate and repo rate, the cost of borrowing increases. That means commercial bank borrows at a higher rate of interest, and hence they are going to lend this money to the public even at a high rate of interest, right? So cost of borrowing increases, lending also becomes costlier, In fact, for the public, borrowing becomes costlier from the commercial banks, and this chain effect results in lesser loan availability for the public, or they are going to take lesser loan from the commercial bank, thereby the Reserve Bank of India, achieving the objective and controlling inflation. Next is reverse repo rate. Now, when we talk about reverse repo rate, it is the rate of interest at which the central bank, that is Reserve Bank of India, borrows from commercial bank. Rate of interest at which central bank. So, if we have this central bank, yeah, let's name it as RBI, and these are the commercial banks, right? Now, commercial banks lend money to RBI. So, loan is from commercial banks to RBI at the rate of, so certain rate is there. So, this rate is known as reverse repo rate. Now, it is RBI who is going to decide that what rate RBI is going to take loan from commercial bank. Now, this is something interesting fact. It is RBI who is going to decide that this is the rate of interest which commercial banks should be lending to the RBI. So, question is, should reverse repo rate be increased or decreased to decrease money supply, to control money supply? Should the reverse repo rate be increased or decreased? So, I am giving you 3 to 4 seconds. Please think over it. Okay. Now, in case your answer is that reverse repo rate should be increased, again it is increased. So, reverse repo rate should be, remember, it should be increased. Now, if it is increased, remember that commercial banks would be attracted to keep more money with RBI, and hence two things will happen, should happen. Number one, they will have lesser money to offer to the public, and similarly, now what they can do, they can give higher rate of interest, as on savings account or on FD and all. They can attract more money, more deposits from common public, and thereby they are absorbing excess liquidity in the market में जो एक्स्ट्रा पैसा जा चुका है उसको अट्रैक्ट करने के लिए, उसको एब्जॉर्ब करने के लिए कमर्शियल बैंक्स भी रेट ऑफ इंटरेस्ट ऑन डिपॉजिट्स, डिफरेंट टाइप के डिपॉजिट्स होते हैं, दैट सेविंग्स डिपॉजिट है, फिक्स डिपॉजिट है, रेकरिंग वगैरह है, तो उन पर हायर रेट ऑफ इंटरेस्ट ऑफर करके पब्लिक से ज्यादा पैसा डिपॉजिट करने के लिए बोल सकती है कमर्शियल बैंक. सो इन दिस वे द प्रोसेस, अगेन दिस अ चेन इफेक्ट, राइट. इससे क्या होगा, आरबीआई कैन make absorb the excess liquid from the market, and this way you can say that inflation can be controlled to some extent. I hope you have understood these 3 points. Now, coincidentally, repo rate should be increased, bank rate should be increased, reverse repo rate should be increased when it's inflation, and if it is deflation in the economy, the meaning would remain same, but the action would be just opposite. During deflation, remember, just if the situation is opposite, repo rate should be decreased, bank rate should be decreased, and reverse repo rate should be decreased, right? Now, let's move on to the next 3 points. Now, we have cash reserve ratio, which is CRR. Okay. Now, in a topic where you must have studied, or like my video will be available for that, like where we have credit creation by commercial banks, you must have gone through that. In that, you must have studied that cash reserve ratio is, this is the minimum amount, and or you can say a ratio of percentage of the deposits which commercial banks must credit with the central bank. That means if we have this as RBI, and this is representing commercial bank, banking system, commercial banks, and this is 1 and 2. We have got 2 categories of public, one depositors and the other borrowers, right? So when depositors, they deposit some amount, deposit, right? So let's take the example 2 lakh rupees, the deposit. If cash reserve ratio is say 10%, now 10% of 2 lakh is 20,000. So out of this 2 lakh, CRR, whatever, say 10%, that means 20,000 must be credited with RBI, and the remaining 1,80,000 can be given as loan to the borrower. Now, in this case, you see that cash reserve ratio was 10%. This is the reason why commercial bank could loan 1,80,000 for this first 2 lakh as initial deposit. But my question to you all is, what should be CRR? Should it be more than 10% or less than 10%? Okay, to give lesser loan, so that commercial bank can give lesser loan to the borrowers. What do you think? Should CRR be increased or decreased so that commercial banks can give lesser loan to the borrowers? Okay, so if your answer is increase, that means CRR should be increased, then you are right. Because just taking an example, if it is say 20%, so 20% of 2 lakh is 40,000. Commercial bank needs to keep 40,000 or credit 40,000 with RBI, and they will be left with only 1,60,000 to lend to the borrowers, right? So in order to decrease money supply, CRR, cash reserve ratio, should also be increased. Then we have statutory liquidity ratio, SLR. Now SLR, you can see it is again something, some little bit similar to cash reserve ratio, but the difference, major difference is that commercial banks need to maintain assets, or you can say liquid assets of particular worth, of particular percentage of the total amount that they are planning to lend to the borrowers. That means whatever amount the commercial banks would be lending to the public, a percentage of that amount they should maintain with themselves, right? In the form of cash, in the form of gold, or any approved liquid assets that they have to maintain. That means higher the SLR, that means more the liquid assets they have to maintain with themselves. So SLR is something that commercial banks must maintain with themselves, okay, as a percentage of the loanable amount, or the amount that they are planning to loan. So it's very simple. Greater the SLR, that means more money they have to keep with themselves, maintain with themselves in the liquid form, and lesser they will be left to advance as a loan. So you have got the answer in this explanation itself. SLR, higher SLR, more money they have to maintain with themselves, and lesser amount for loan. I hope it is clear. And last topic is OMO, that is open market operations, right? Now open market operations refers to sale, or yeah, you can say and purchase of government approved securities, right, or bonds in the open market. By the central bank. So remember, it's sale or and purchase of the government bonds or approved securities and bonds in the open market by the central bank. Now the question is, during inflation, should the central bank sell or purchase? Now you have to remember, when we are talking about this, right? So when we are talking about the sale and purchase of the security, so what do you think? What do you think if RBI say sells the bonds, government bonds or securities, ठीक है ना, in the market. So what is going to happen? Money would flow from market to some point and finally to RBI. Remember that when RBI sells bonds and securities in the market, money would flow from market towards RBI, and hence public will be left with lesser money to spend. So the answer is very simple: sell. So during the inflationary tendency in the economy, what RBI should be doing under this open market operations, RBI should be selling off the government bonds and securities in the market so they can absorb excess liquid from the market. And during deflation, okay, during recessionary tendencies, RBI should be purchasing so that they can infuse, so that they can, inject more money in the market, but during deflation. So you have to be very careful what the situation is being asked, as a situation is given. Okay, accordingly you are going to answer. So the next topic, a subtopic we can say, is qualitative method. Okay, so qualitative methods comprises of certain points we are going to discuss. Okay, now students, we are going to discuss the qualitative methods. Qualitative methods, which are also known as selective methods, as I have already mentioned, stated in the beginning of the video, right? So selective means for a specific purpose, specific region, specific consumers. Okay, yeah, specific good, specific particular period of time. It can be any specific. So we have got few points or few measures under these qualitative methods. Number one is change in margin requirement. What is the meaning of margin? Before that, before we understanding that, yeah, before we understand the meaning of margin, suppose a consumer goes to the bank, okay, to borrow some amount. Now bank would say that there must be some property to be mortgaged, okay, against which the loan can be sanctioned. Now there is a value, means like, I mean, market value of that property, which is assessed by the bank. After assessing the value, that is known as the value of the mortgage property. So when we say value of mortgaged property, okay, bank gives loan, yeah, lends the money, a particular percentage of this value mortgage, a particular percentage, in the sense 80%. So whatever the amount the bank agrees to give as loan, to advance as loan, that is the loanable amount. Now the value of mortgage property minus this loanable amount, the difference is called margin. The difference is margin. For example, the value of mortgage property is say 80 lakhs, and the loan that bank agrees to give is say 70%. So 70% of this 80 lakhs. So 80 lakhs is out here, this, and loanable amount is 70% of 80 lakhs, which is 56 lakhs, right? So we can say that the value of mortgage property is 80 lakhs, bank is ready to give 56 lakhs as a loan. The difference of 80 and 56, which is 24 lakhs. 24 lakhs is the margin. So you need to understand the meaning of margin. Now the consumer, the borrower gets 56 lakhs, say, but during inflation, to affect particular type of loan for particular commodity for particular consumer, what bank does, yeah, what should be done to decrease money supply? The margin should be increased. Don't you think that margin should be increased? If margin is increased, remember the loanable amount will decrease. So the margin is 40%, which means the loanable amount will be only with 60% of 80 lakhs, which is say 48 lakhs. So overall, by increasing the margin, the loanable amount decreases and hence the consumer gets lesser loan and the objective is achieved. The next topic is regulation of consumers credit. Now whenever consumer, okay, purchases any commodity, it can be any durable goods, okay, it can be in fact cars, the vehicle, it can be flats, buildings, anything. Whenever whenever consumer purchases anything on credit, it can be in this form. There must be a down payment, DP. There should be an there will be an EMI for that. So down payment and EMI, these two are very important component whenever consumer goes for finance and purchase anything on finance. So DP is a down payment, that is a one time payment that has to be made initially to purchase anything on finance, and EMI, that is equated monthly installment. Now it has again various components, out of which two major components are, rate of interest, you can say rate of interest, and tenure. That means for how long these EMI would continue. That means for how long, in how many months this loan has to be repaid, and rate of interest, as we all know. So these two are very important determinant of whether the consumer would be purchasing that durable good for whether he's going to purchase or not going to purchase, right? So what do you think that RBI should be asking the commercial banks to bring some changes? When we say regulation of consumer credit, means important major changes to be brought in these two categories. Okay, so number one, DP should be increased. That means higher the DP, or greater is the DP, that is down payment, the consumer would be discouraged, because the consumer may not able to pay a big amount initially and he may drop the idea of purchasing that durable good. Number one. Number two, to make EMI little bit bigger, what what commercial banks should be doing, increase the rate of interest and decrease the tenure. By decreasing tenure and by increasing rate of interest, or even both, the EMI amount may be very high, due to which again the consumer may drop the idea of purchasing that particular durable good, and hence the objective is achieved, right? So under regulation of consumer credit, it is down payment and EMI regulations needs to be done in these, so that the consumer can, the consumer have to think twice before purchasing or before demanding the durable good. The next points, we have credit rationing. Now these points are comparatively simple points. Now credit rationing, which is sometimes also known as credit ceiling. Now this credit ceiling out here means limiting the credit by commercial bank for the consumers, say for particular good. It is very much possible that initially the credit limit for the real estate sector, say, was 200 crores per day by the different banks. Just an example, that for real estate sector, the credit limit was 200 crores per day by the different banks. Now, Reserve Bank of India recognizes this point, that real estate sector, the money is flowing to the real estate sector, which needs to be curbed, which needs to be decreased, right? So what RBI may ask the commercial bank to limit the credit given to the real estate sector. That means initially, say it was rupees 200 crores, that has to be brought down, say, to 150 crores for real estate. Now Now, this is a very good example where you can understand the meaning of selective. As I mentioned earlier, whenever Reserve Bank of India uses this tool, that is qualitative method or selective method, selective control methods, out here only real estate sector is targeted. So by limiting, by decreasing the limit, okay, the amount flowing to real estate sector would decrease. Then we have points like, moral suasion, where on the moral grounds, the central bank can persuade the commercial banks that what is good and what is not good in the interest of the economy, and by showing the pros and cons of lending money, okay, easily to the consumer, how it is going to affect economy's health. So on moral grounds, commercial bank is persuaded by the central bank and given the guidelines to be very specific while giving loan to the public. Then we have publications through various printed publications, you can say, through various digital publications, you can say, over the websites, journals, okay, and magazines and all. Commercial banks are informed, right, by the by the central bank what is to be done when it is inflation, how to contribute in decreasing inflation or combating inflation. And direct action means ultimately the commercial banks, okay, may face direct action by the central bank if they are not abiding by the guidelines, the rules during inflation or during economic fluctuations, right? So in direct action, you have to keep in mind that the commercial banks may have to face, like, there is non-availability of cash. Non-availability cash in the sense means, like, commercial banks may not get the facility of loan during the time of financial crisis. So it is very much important for the commercial banks to understand that if it do not follow the guidelines by the central bank, they may have to face some actions which may not be in their favor. So in this way, we can conclude that commercial banks, in fact, the central bank through commercial banks regulate money supply and combat inflation as well as recover the economy from recession when it is required. I hope you have understood. You are suggested to go through the video as many times as possible if you don't understand in the first instance. Good luck. Thank you.